to Crunch the Numbers, where we talk everything finance related. Today, we will find out what is a trader, what does a trader do, are there several types of trader? Also, what's the difference between a conservative investor and a more progressive investor? How does that risk averseness actually affect the way you manage your portfolio? What types of investments are you more prone to participate in? Regarding that, of course, we'll talk about cryptocurrencies, namely Bitcoin, and a little bit about the news on the short squeeze of Gamestop. Should there be regulation for such a market manipulation? What does that say about the rationality of investors and the theory of market efficiency? So today, our guest is an experienced trader, regional manager at INFINOX Capital, Tiago Cardoso. So join us as we dive into the world of finance. Thank you so much, Tiago, for joining us. It's truly a pleasure. So today we're going to start to talk about a little bit about your career, about trading, a little bit about cryptocurrencies. So what are they? How is their price influenced? And with a little nuance about portfolio managing. So for starters, can you tell us a little bit about your path, academics, and career in general?
Yeah, thank you very much beforehand for having me here. It's always a pleasure. I actually started very early to try to understand a little bit about trading. I remember when I was, I believe around like 10 years old, I remember in the mornings to watch Euronews, and every day they were showing the performances of the stock market. And I always, every day looking at that, I always tried to understand a little bit more. I was very, very young. And I believe that was the foundation of some of the interest that then built up within myself. Then I had the opportunity to start trading with a demo account when I was around 15 years old. And it was very interesting because it wasn't actually a demo account. Back then there was no demo account, so you had to actually fund your account. So I spoke with my father, spoke with my parents, and they ended up funding that account. I then started trading myself on a real account, but obviously without knowing much about the markets, without knowing much about what I was doing. I remember my first trade was actually, I think I bought euro against the Icelandic kron, which is a currency that then was extinguished. But it's interesting to see that the market before was very different than what it is now, and the kind of information that we had before was completely different than we have now. So I started trading myself. I started learning with my own errors, with my own mistakes. I remember I tried every single indicator that existed. I had RSIs, moving averages, Bollinger Bands, Ishimoku clouds, everything. I tried everything, always on a real account, never on demo. And I think the fact that I started by trading on a real account was what created in myself a mindset where I took it very seriously, because it was real money. It wasn't a demo account, it wasn't fake money. And when it's fake money, people just give it a try and they don't take it seriously enough. But all of that aggregated led me to try to understand things better, to try to learn it better. And I ended up being very profitable when I was 17, 18 years old. Reminder that you cannot open an account when you are under 18. I was lucky enough to use my father's account. But I actually had amazing returns. I was studying at university back then, but that was a second, like I wasn't paying too much attention. I was every day just looking at the screen, just trying to learn a bit more. The trading environment is not like it is right now, which I think everyone right now, everyone who's 18 or 19 or 20 years old, everyone knows what Forex is because of all the movements that exist around, with all the trading curses that are sold everywhere. Some of them are good, some of them are not, but there wasn't the awareness that exists today. And that was interesting because that was very exotic for me because no one knew what Forex was. No one knew. We had I think it was like 3 brokers here in Portugal that allowed us to trade Forex. It was through the Saxo Bank platform. I was trading back then with Bank Best. I remember euro dollar was the cost to trade euro dollar was 5 pips. Nowadays it's almost 0 pips the cost. Plus you had to pay a commission, so it was really it was completely different time back then. But again, it developed me myself. I ended up taking it very, very seriously. I ended my university, and I was lucky enough to have my first job in a broker, which was XTB back then. And then I had the chance to understand how a broker works. Also to develop a bit of the sales side, which is also always important in your life to develop your sales skills, because you will always need to sell something in the future. If not yourself, a product. If not a product, you will always have to sell yourself. So that was very interesting because I had the chance to learn how to work in a broker, how everything works in the back end, how everything works behind the graphics, behind the platform. And that was really, really interesting. I stayed there for around 9 years. And then I had the chance to come to INFINOX, where it's a completely different world, because I have the chance to work worldwide. I have the chance to work with people in Africa, people in Asia, people in South America. Everyone is really different. The cultures are completely different. But we have a more worldwide perspective of the dynamics of these markets and of different types of clients. So all in all, that was a bit of my path. And of course, I keep trading. I look a lot. I pay a lot of attention to the cryptocurrencies market, to the stock market. All of these different assets should require a different perspective in the way you approach the trading of these assets. But it's something obviously that I believe I will be doing until I die.
So I see, even when there wasn't a lot of information, you already had that interest, and you, from what I perceived, you went to research for yourself, got a little bit of hands-on experience. But in today's age, there is a lot of information available. We can all research with our phones, call anyone, go to a seminar and hear someone talk. But still, I think the perception of people that they know something instead of going to research is increasing. So they think they know, but they actually don't know. So in this sense, I think most of us have seen the Wolf of Wall Street movie. So that big brokerage firm. So is that really what the trader is? Is that the life of a trader? What is the day of a trader?
No. It's nothing like that. It's nothing like that. Obviously, that's a dramatic approach of the how it was. Probably it was like that in the back in the days when we obviously weren't alive back then. But nowadays, I think there's different types of traders, different types of how people approach trading. I had the chance to work with a lot of amazing traders in my life, as my clients, as partners, and they are all different. You have the people that are very low profile in the way they deal with the market. They keep themselves very low profile. They don't show up. They don't show off the results. Those are actually the most important people that I have met, the most successful people that I have met, the ones that don't show off the results. And it's interesting because they end up being the ones who work the most, who research the most, and have a clear trading plan, opposite to the ones that just like to show off or just like to fake that they really think they know what they are doing. But I think it's very different from everyone's perspective. I think it's more on planning the kind of trade or the kind of approach to the market that you want to have, rather than just spend the day in front of a computer. And that is, I believe that the majority of people think a trader just stays the whole day in front of a computer, just looking at the graphics, and that's it. Actually, it's not. The best traders are the ones who are very clear in their ideas, are very clear in the way they manage their risk. They have very good tools to mitigate the risk they do, and they just let the profits run. They just let their strategies run, and that's basically it. I also had the opportunity to meet a lot of algo traders, and those are basically a completely different segment of trading. They are basically computer engineers, where they are just basically trying to fix or to improve or to tweak the algorithms that they develop, and they don't care about what's going on the calendar, what's going on with the Fed, what's going on with the graphics. They just look at the algorithms, and all their day just to try to fix that and to tweak and to improve their algorithms. So it's very different. The kind of traders that exist, the kind of the type of day that a trader has, it's completely different from the different type of traders that exist.
So, and with this increase in info, there is also a larger accessibility of people to the stock market. We just need to install an app on our phones, register on the platform, and then we become an investor, essentially, with or without the prior knowledge. So, regarding this, are you registering an increase of new accounts in your platform, or do you think that that movement was strictly in the USA?
No, not at all. I think it's worldwide, and it's interesting because I have obviously a worldwide perspective of this phenomenon. I'm not just based in the Portuguese market. I see regions like Africa that are really now getting into this kind of activity. They are basically learning a lot about trading. They are very eager to start trading, and I believe that right now, looking globally at our operations, I think Africa is the country where we have seen more registration. Probably because they now have access to information they didn't have, or they don't, like 2 years ago or 5 years ago, they didn't have the information or the access to information that an American citizen had or a European citizen. Now they are having access to that kind of information. They are developing themselves technologically. They are discovering new ways of accessing the markets, and it's really interesting to see that probably Africa, India, and South America in some countries is where we have seen the biggest increase in clients. Obviously, they end up always trading. I would say more indices rather than forex or than commodities. I think they are nowadays aware that trading an index, it's probably cheaper, it's probably less riskier than just trade one stock, and it's different regions. They don't have access to platforms that we have. So they basically trade on the mobile phone. So it's really interesting to see this phenomenon in these different geographies, and I think it's a trend that is going to keep happening in the future. But definitely a very big increase in terms of accounts open and new clients that we have worldwide, but specifically in these regions.
And so, from what I perceive, there is this difference between our generation and the previous generation in the type of mentality that we have when it comes to investment. Even when the previous generation was our age, I perceive them as more conservative, but also in their age, there weren't as many options as there are today. So we have a lot of growth companies, technological companies, but we also have access to a lot of derivatives and cryptocurrencies even. So in this sense, do you think younger investors are being stolen by cryptocurrencies um, they're being moved away from the traditional equity and bond market to the cryptocurrency market?
That's a good question, but I think it's generational. I think that the generation before perceived stocks a bit like the generation now perceives crypto, because back then you just had a couple of instruments to trade. People were less keen to risk as much as they are today, so they were more keen to trade or to invest in different assets. We are talking about real estate, we are talking about even bonds and fixed income, and they saw stocks. And one of the phenomena that justify that is, for example, the pump and dump of, if we want to call it the pump and dump of Nasdaq in the early 2000, where people started to trade tech stocks that had no fundamental behind to have that kind of valuation. And if we look at now, that's a bit of what's happening with cryptocurrencies. We have thousands and thousands of cryptocurrencies. Each one justifies its value by mentioning just one or two features that in the end doesn't have any value, but people buy them. And one of the good examples is, for example, what's happening today. Just today, we are seeing, and we have seen the pump and up of Gamestop and AMC and so on. And we are seeing today a bit of that in the crypto markets with Dogecoin. And the manipulation that can exist in these markets are much bigger, which if we speak to a 19-year-old and if we ask them if they want to buy Apple, where they can get 1.5% dividend per year and probably a return of 5% per year, does he prefer that, or does he prefer the chance to lose everything but also be able to make like 2,000% a year, or 2,000% in a big movement that Dogecoin can have or Ethereum can have? Obviously, these people that young investors are more keen to risk. Young investors are more keen to try to discover what they have no idea about, what it is. And I think that the fact that we are seeing young investors to move more towards trading crypto is based on that. It's based on the fact that they really want to understand a bit more about easy money. They want to learn how they can have access to better returns. They don't actually look on the long term. They just look at the short term. But I think that's part of the age. I think it's part of the learning curve that an investor needs to have. I was like that. Obviously, everyone needs to make 10% a day or 100% in a week. Everyone wants that, but we need to get burned on those movements. We need to get burned on potential pump and up schemes to understand really that doesn't make sense for an investor, and that doesn't make sense for the long run.
So I think from what I talk to people, what many don't understand is what influences the price of a cryptocurrency. Is it just demand and supply? Because I've seen an article today regarding Elon Musk, and this is not the first time that's happened. So Elon Musk added in his bio #Bitcoin, and today just jumped 20% higher. So what exactly influences the price of a cryptocurrency?
Just purely offer and demand, and the fact that the demand is moved by the FOMO, is moved by the fear of missing out. Remember that Bitcoin 10 years ago when it was created, or 11 years ago when it was created, it was worth basically zero. And how much was the return of those who bought Bitcoin when it was 1 year old, when Bitcoin was just created? It's ridiculous, the returns. And people are really, really hungry for missing that, for missing those movements. And they think that because Bitcoin went up, or any other cryptocurrency went up 100, 200, 1,000, 10,000%, that will happen again. And it's much more easier for that to happen in a cryptocurrency rather than on a stock or on an index, on a currency or on a commodity. So the kind of investor that is attracted to trade cryptocurrency is the investor that is, one, manipulated, and that's the case, for example, for what we see with Elon Musk and what we saw today, for example, when he posted on his profile just the word Bitcoin, and Bitcoin went up 10%, and 10% in Bitcoin market cap is a lot. It's not. It's much more than what it is with Gamestop. So I think it's that they are driven by the manipulation, by the fact that they can make easy money with trading crypto, and with the fact that they have the fear of missing out on another possible bull run where they can make another 100%. And the kind of investor, of trader that trade on cryptocurrency is a very young trader. It's a very young profile. It's a very young profile that doesn't have any idea of what trading is. It's not, we cannot even call him a trader, but it's a person that doesn't know what Bitcoin is or doesn't know what a cryptocurrency is. They just know that his friend made money, or they saw someone in the internet saying that they made money, and they want that. Then they have, again, the fear of missing out on that, the FOMO.
So it's essentially a very speculative, very volatile market. But do you think it's worth exploring, particularly for younger investors that don't have that money saved for retirement? So they have a much higher security when investing because they don't really need that money per se.
For sure, and obviously, I'm just saying this. Sounds like I'm being very, very rough on crypto. That's not true, because I really believe in what. In some things that Bitcoin defends by itself, but I think it's important for people to not be fooled by what. And I've been trading crypto for a long time. I burned myself a lot in a lot of ICOs 4 years ago, 5 years ago. So I understand that there should be more research on some projects that are out there. But if we want to essentially just look at Bitcoin actually is a great asset. It's a great asset that protects you against inflation. It's a great asset that gives you the possibility of hedging yourself against inflation in a digital way, when back then it was only gold. And part of the reason why Bitcoin is growing so much is not because of the young investors that are buying Bitcoin. It's actually because of the institutions that are buying ETFs of Bitcoin. And if you look at what happened this year with COVID and what happened with central banks raising a lot of money, injecting a lot of money, a lot of liquidity in the market, led to a lot of demand for Bitcoin, because it's an asset that cannot be increased. It's not like our euros or our dollars that are printed every single day. And because of that, because of the stock of dollars or of euros that are growing constantly, the price of it decreases. With Bitcoin, that doesn't happen. And the fact that we have seen a lot of investors and institutional investors protecting themselves against that decreasing value of dollars and of euros, of fiat, led to a big demand in Bitcoin. And it's interesting to see that a lot of these. How much did Bitcoin increase these last 6 months? Probably, I would say probably 300%. A lot of that increase was actually demand from these institutions. We can see that by the ETFs, because young investors don't buy an ETF that has Bitcoin has a collateral. Yeah, it's interesting to see that, and it's interesting to see that that is what is holding the demand for not only for Bitcoin, but for basically all the the crypto assets, those that offer obviously some safety.
So we've talked a bit about portfolio, but in a more theoretical approach, or so for the general population, for the casual investor that doesn't have much to invest, how do you think that portfolio should be structured? And does it change depending on the size of the portfolio? So investors with less money should buy different assets than investors with more money.
I think that's up for each individual to decide, not in terms of the dollar value or euro value of your portfolio, but in terms of the position that you want to have in terms of risk, the approach that you do with the risk. Probably if I'm a young investor and I have $10,000 to invest, I'll probably be looking at stocks that have grown a lot, but that still have a lot of room to still grow in the next 20 years. Probably I will be looking at Bitcoin. Probably I'm not going to be looking at buying 10-year treasuries from the United States, okay? Or ETFs that track the S&P 500. Probably I will be keen to take a little bit more risk in my portfolio. But I think it depends on the type of approach that we have to risk. I personally, what I like to do is I like to look at stocks on a very long-term perspective, and to also approach small, short-term opportunities that arise. We had the case with gold in the last few months. We had the opportunity of shorting dollar in the last few months, also with the central bank, with the Fed increasing the balance sheet, which led to a big devaluation of the dollar, which led us to take the opportunity of buying, for example, NZD USD, Australian dollar, Euro dollar. I think we should be prepared, and we should have a small portion of our portfolio to take advantage of those riskier and short-term opportunities that arise. And this year was an amazing year, or 2020 was an amazing year to take the opportunity to be on those short-term opportunities. But it was also a great year to let our long-term approach to run. And if you have bought Apple 2 years ago, if you have bought Microsoft 2 years ago, those are quite safe stocks, even though they are on the technological side. But they also grew a lot. And even though they are more safe bets, they still had almost the same return as the more riskier bets that we would take. So I think it's, in the end, to answer the question, I think it depends on the age. It depends, because of the age, depends also on the risk you want to take, but not much in terms of the size, the dollar size of your portfolio, because in the end it's all about percentages. If you have a 100 euro portfolio or a 100,000 euro portfolio, you should always treat them exactly with the same percentage split in terms of the short-term opportunities and the long-term opportunities that you have to capture.
And how do you combine those short-term and long-term opportunities? So how do you combine trading with investing?
Well, personally, I look at investing more with long-term stocks that I want to let the profits run. I tend to look at stocks that grow the dividends, mainly. I look a lot at rates that obviously pay a very high dividend. They don't offer as much of a growth opportunity as the tech stocks, but still they pay you a lot in dividends, and that creates your yearly income that you will then reinvest in buying more stocks. So I tend to look on the long-term perspective. I tend to look more in buying stocks that pay you, or that not only pay you a good dividend, but also grow that dividend on long term. And if they are growing the dividend, means that they are being profitable. And if they are being profitable and they are being successful, this means that the price of the stock has everything to increase in the long term. Because that will attract more investors. So I have my portfolio. I leave that portfolio to grow themselves. Usually when I buy a stock, I tend never to sell that stock. My idea is to have that stock forever with me for the next 30 to 40 years. And then I have a smaller portfolio, smaller percentage, 10-15% tops that I use to try to identify short-term opportunities. And I just said that we had a lot of opportunities this year with commodities. We had the oil going to the futures of oil. I think it was the March futures to go, or May futures to go to negative territory. So we had an amazing year of short-term opportunities. And that is the kind of, that percentage, 10 to 15% is the percentage that I leave in a different account, where I try to identify these opportunities. They might arise, they might not, but we have to be prepared for those opportunities, and we always have to leave some cash, some free cash to try to take those opportunities.
So you mentioned earlier Gamestop. So with the recent short squeeze, how do you view it? What does it say about the rationality of investors and the theory of market efficiency?
It's very interesting because this is probably this is not the market rationality fault. This is Fed's fault, and this is the fault. This happened because with the amount of liquidity that we have in the markets, there is chance to do this. And I mean, is it legal to do this? Do we need more regulation to stop this? In the end of the day, there was more people wanting to buy the stock rather than selling the stock. And on one side, you have hedge funds trying to make money on shorting stocks. That actually it's true. There's no fundamental for those stocks to grow. Only fundamentals to see that the price decrease in the medium to long term, which is the case of Gamestop, which obviously it's a very weak company. On the other side, we have so much liquidity in the market that you can just gather around 1,000. I think it was much more people than that, but can gather around 1,000 people, 10,000 people, 100,000 people, and try to manipulate the market and take advantage of all that liquidity. This is not new. This is something that has happened so many times in the past. We had this happening so many times here in Portugal with, for example, with BCP, with the stocks of BCP. That happened a lot in the past, where just a group of people try to manipulate the price. We see that every day in small cap stocks with the pump and dump schemes that exist. This was the first time, or as long as I remember, in the last few years, that we have seen this happening in a big stock or in a big name that a lot of hedge funds are tracking to short. So I think it's not efficiency of the markets. Actually, they are very effective. That's why it grew up the stock, because there were more people buying rather than selling. Although there were a lot of people selling, but it also happened because there are a lot of companies, a lot of hedge funds that are shorting stocks and avoiding the price to go up on a more organic basis. And these hedge funds are looking at companies, and there are a lot of investors, not only hedge funds, that look at companies, and they look at the short flow, the short positions that stock has. And unfortunately, a lot of people are now looking at that as a fundamental of the company, which is not true. Looking at the short positions and the percentage of shorting positions that the stock has should never be a fundamental of the stock. There is a consequence of the fact that the stock is bad. or good, or as bad as people perceive it is. So I don't think it's something that we are going to see in the future. I think that every time we pass through a situation like this, the market participants tend to defend themselves. So I believe that the fact that this happened to GameStop, happened to AMC, even happened to Bed Bath and Beyond, will lead the market participants, mainly those hedge funds that are shorting stocks, to avoid being short squeezed and avoid taking these again. So I think we are not going to see this again. I know that there is trending on there is some posts trending on Reddit with these people trying to do this again, but in the cryptocurrency market, mainly on Doge. Doge went up like Dogecoin went up like 1,000% since yesterday. They want it to grow 2,000% more. So I think these people are now, or this group of people that are try to manipulate these prices, are now trying to go to less regulated markets like cryptocurrencies. It will always happen this as long as there are the freedom to buy and to sell.
So for my final question, I want to base them on two perspectives. So first, we can see that there is a growing tendency to not exactly look at the fundamentals of a company in order to invest. We can see that with Tesla, that has a PE ratio of around 800 to 1,000, which is incredible. So we could translate that to this case, but also, why is there a need to talk about regulation now? Because can you explain to me the difference between a group of Reddit users rallying to buying a stock and big hedge funds coming on national TV and talking and advising to buy that stock for their own portfolio to grow up? So what's
it's basically the same. It's as similar as it is, and we have the example of Elon Musk constantly doing that on his Twitter account. If it's not Signal, it's Gamestop. If it's not Gamestop, stock is today Bitcoin. This will always happen, unfortunately. Do we need as much regulation? How do we approach regulation to these guys? How do we regulate them? How do we regulate someone to use his social media account? It's impossible. How do we regulate this kind of stuff? It's very difficult. And we see that, for example, the brokers try to avoid bigger losses with stopping the trading of GameStop. They stopped the game, as they said. But from a regulatory perspective, I think it's very difficult for the regulators. Yes, they can decrease the leverages, just like they did 2 years ago with the brokers. They can put a lot of limitations, but in the end, it's a group of people that are boosting more demand than offer, which will always leave a stock to grow up or to fall according to what people want.
So you're saying it's difficult to regulate. My question is, should it be regulated?
I tend to believe that the free market is the way to go, but also I'm not a fan of the naive market, and that might put a lot of investors in a situation where they cannot defend themselves. And the regulation exists, or should exist, to defend the investors that don't understand or don't know how to protect themselves of the risk of the market. Regulation should exist, obviously, always, for the market participants, but when we live in a society that is led by the free market, it's very difficult to regulate the market by itself. You can regulate the market participants, but never the market.
Okay, so that was my final question. Tiago, thank you so much for coming.
Thank you very much.
Our listeners learned from you as much as I did. So thank you so much for coming, and please leave a like on our social media. We'll identify Tiago. Please stop by his Instagram page and his website. It's all there. So I'll see you all next time.
Thank you very much. It was a pleasure.